Hello everyone. In this video we are going to address two questions and I'll share my thoughts and my working on what were the returns on different asset classes. So the first question is that what were the returns in different classes of assets in 15 years, 25 years and 50 years. So the assets that I've considered here are the equity markets from Pakistan, India, Dubai, USA and Europe. So we will see that what were the returns of these equities in 15, 25 and 50 years. Number two, how did these returns fare with other asset classes, for example, with gold and with property? Had we invested 15 years back or 25 or 50 years back in alternate assets like gold or property? So to start with, we'll start with Pakistan since I belong to Pakistan. So we'll see that what were the average returns of the Pakistan market in 15 years from 2010 to 2025, from 2000 to 2025, which is 25 years returns, and 1975 to 2025. We will not consider it in the case of Pakistan because I did not have the index readings from before pre 2000. So we are going to talk about 15 and 25 years. So if you look at the index returns in case of Pakistan, the index in 2010, by the time Pervez Musharraf had stepped down and it was President Zardari's government, so at that time the index was faring at 10,000. The KSE 100 index was at 10,000, which stands at 130,000 roughly today. So this averages out at 21.6% CAGR or 21.6% year-on-year return. However, the rupee also depreciated from 70 rupees to a dollar in 2010 to 280 roughly today. So the rupee also lost a value of 9.5%. So if we take the inflation adjusted return, so it would be 12% year-on-year CAGR or return for the last 15 years. If we extend the same returns from 2000 to 2025, this would be at 25%. So in Pak rupee terms, the return was around 23%. However, the rupee lost versus dollar at a 6.5% roughly. So this comes out to be approximately 17% return. This is year on year 17% return if we take 25% to 25 years of an average window. Now let's go to our second market, which is our second market is India. So we are going to consider India. So basically in India, if you look at 15 years return, the market went from a 16,000. We are talking about Sensex, which is one of the leading index in India. So it went from 16,000 to 83,000 in 15 years. The average return comes out to be 13.1%. However, the Indian rupee also depreciated like Pakistani rupee. So if we factor in the 4.5% inflation of the Indian rupee, that is around 4% of an inflation for the Indian rupee. The average return is 9.5%. In 15 years. The same return, if we take for 25 years, the index went from 5,000 to 83,000 in 25 years. If we do an adjustment or the inflation adjustment of 2.5%, the net return turns out to be 20%. So if you look one thing, it is a very interesting fact between these two numbers. If you look at 25 years return, the Pakistan KSE index returned 17%, while India returned roughly 20%. So considering the downturns in Pakistan, and then there are a lot of political turmoil, the Pakistan stock market still returned a very good 17% as compared to India's 20%, where for India these two and a half decades were extremely strong decades. But still, this is the beauty of stock market, that this is the beauty of good companies actually, that if you are invested with good companies, no matter, it does not matter so much that in which environment they operate. If these companies are resilient, the companies do take care of downturns, which can be political, economic or anything. Next we move to Dubai. So in Dubai stock market, basically I had the readings only for 15 years, so I could not see the standing of the index before 2010. So in 15 years, Dubai index has returned 10.5%. As you can see here, I have not taken the dollar inflation here because AED is pegged to US dollar, so there AED did not get inflated versus the dollar in these 15 years window. So it returned 10.5% in 15 years. And next we go to Germany. I've taken the biggest economy from Europe as an example here, which is Germany is the biggest economy in Europe. So it returned 11.5% in 15 years average. The return in 25 years was a bit low, 7%, and of 25 years is also around 10%. So the German index, it has fluctuated between 12% and 10%, but roughly if we look at a very big window, which is 50 years, which this gives us a more accurate reading, so it is around 10% year on year return. US SPX, as you might know, it is US S&P 500 index, so it returned 11.5% in 15 years, 7.5% in 25 years, and roughly 11% again in 25 years. Now, you might have heard a lot of people saying that the stock market returns on a considerably big window is 10%. So this is that we see 10% on 50 years. You know, wherever you see the indices return on 25 and 50 years, it would be hovering around the 10% returns. So I've also tried to take an average of these returns over, so the average of the 15 years of all the stock markets, the average is around 11%, is around 12% for 25 years, and is around 10.5% for 25 years. So the average is also between 10 to 12% roughly. Okay. This is one of the key findings that I wanted to share with you. And next, when we will do a quick comparison of how did the stock market returns fare versus gold and land. Now we need to keep these numbers in our, please keep these numbers in mind, which is roughly 10 to 12% of a return for all the stocks across 15 years, 25 years, or 50 years. And the second one that we are going to compare is versus gold. So the gold has returned 6.5% versus 10.5% for stocks in 50 years window. It has returned 10% versus roughly 12.5% in a 25 years window, and on a 15 years window, the gold has returned 7.5% versus 11%. So you can very easily see that had you invested 25 years ago or 15 years ago, had you invested in gold, you would have, the stock market has beaten the gold by roughly 3 to 4% year on year. So this becomes a very big impact, and I'll show you towards the end of this video that what difference does a 2 to 3% of a fluctuation in return makes over a 15 or 25 years window. The last one, I've taken an example. Since I belong to Pakistan, I was able to get some returns for properties in 25 and 33 years. Here, just to, there is one disclaimer that I want to make, that the returns that we have taken here are for the best property in Pakistan. So I've taken, for instance, between Lahore and Karachi, I've taken Defense Housing Authority as a benchmark, and in Islamabad, I've taken CDA as a benchmark. So it has returned around 11.5% in 25 years. But please note that this is across the top-notch property projects in Pakistan, which is CDA or DHA. So it has also returned quite strongly, which is 11% in a 25 years window. It is still roughly 2% lesser than stock market returns, and it is still, but it is in between stock market and gold returns, as anybody would expect. Now, I was in between the video, I mentioned to you that the 2 to 3% makes a very big impact on your long-term returns. So what I've tried to do here is that if you invest $1,000 at a 12% return for 20 years, this $1,000 equals roughly $10,000 on a 12% return. The same 1,000 for 20 years on a 2% lesser return makes it 6,700, which is roughly 30% lesser. If you reduce it by another 2%, instead of 10%, we make it 8% for 20 years, the same $1,000, it would be equal to roughly $5,000, which is another 30% lesser. So this is of extreme importance that when we invest in any class of properties, the few percentage points, it compounds over 25 years and it gives a very staggering number, which is sometimes unbelievable, that in this case, the 2% year on year can result in a 30% net increase or a decrease in wealth versus between the two alternates. So one should be very cognizant that what are we investing into, because these investment decisions can give you completely different results, as I've tried to show you here, over a 20 years window. So with this, I conclude my video. I started the video with two questions. The first question was that what is the best class to invest in? Definitely, we have tried to see two different Asian markets between Pakistan and India. We have also seen one leading market from Middle East. We have compared it with European market, which is Germany and US. So across all the different equity markets, no matter which equity market you were playing with, if you had invested $1,000 in any of these equity markets 50 years ago or 25 years ago, you would have made roughly the same amount of returns. As you can see that in a 15 to 25 years window, stocks always return 10 to 12% roughly. With gold, it is gold is in between. Land has also fairly returned, so I would put land or property between the stocks and gold in this case. Now, there are also some other assets. A very hot one these days is Bitcoin, which I do not understand, so I would not make a comment on that. But if you understand Bitcoin, you can also evaluate and you can also see what would be its return in the next 10, 15, 25 years. But of all the asset classes that I understand, and I've been investing for good 10 years now, I can very clearly identify that all these different asset classes, the equity market, the capital markets, if you invest in relatively good companies, it is much better than investing in any other asset class. So I think these were the answers to the two questions with which we started. And I leave you with these thoughts. I would urge you to invest in equity markets. However, the best way to invest in equity market, as Warren Buffett also says, that for 90% of the people who do not understand investing or do not have the time to understand the capital and equity markets, the safest bet is to invest in a index fund. So all of these returns that we discussed today, these are based on index funds. Definitely for the people who can understand the stocks a little bit more, and if they are able to invest in slightly better than the average companies, their returns might go around between 14 to 16%, even higher than this. For example, Warren Buffett has been able to return roughly 20% in his 70 years of investing career. Peter Lynch is another example. He was able to return 29% over his career of 20 years. So there are a lot of different successful investors, but for most of the people who do not understand investing, the safest bet for them is to invest in index funds. So I leave you with these thoughts. Please leave your comments in the suggestions. And this was my first video. I'll try to bring more content on investing and value investing and different kinds of assets out there in the market. Thank you very much for watching this video. Take care. Bye.